How do investors measure commodity market volatility? Imagine trying to predict the weather without a forecast. That's similar to what investors face when trying to gauge how wild commodity prices might get. Understanding how to measure this unpredictability is key to managing risks and making smart decisions. Investors mainly use two ways to measure volatility. The first is called standard deviation. It looks at how much prices have moved around their average over a certain period. If prices jump around a lot, the standard deviation is high. This method helps predict future price swings based on past data, but it doesn't tell you which way prices will go. The second method is beta. It compares a commodity's price movements to the overall market. If a commodity has a high beta, it tends to move more than the market does, meaning higher risk and potential reward. Another way investors gauge volatility is through implied volatility models. These models use option prices to estimate what the market expects for future price swings. The most common one is called the Black-Scholes model. It looks at current option prices on commodity futures to calculate expected volatility. For agricultural commodities like corn or wheat, implied volatility often gives a better picture of what traders expect than just looking at past prices. However, it can sometimes overstate actual future movements, especially when options are priced at levels that suggest more risk than actually exists. There are also advanced tools like the CME Group Volatility Index, often called the CVOL. This index uses a more refined method to measure expected volatility. Instead of just looking at one point on the implied volatility curve, it considers the entire curve. This approach gives a more balanced view of what traders expect over the next 30 days. It assigns equal importance to all strike prices in the options market, reducing bias and providing a clearer picture of market risk. Because it uses highly liquid options across many commodities, it offers a consistent way to compare different markets. For investors, knowing how volatile a commodity might be helps in planning their strategies. If volatility is high, prices could change sharply in a short time. This means potential for big gains but also big losses. To manage this, investors often use derivatives like futures, options, or swaps to hedge their positions. They also watch multiple volatility indicators at once because each method can tell a slightly different story. Combining these measures helps them decide how much to invest, when to buy or sell, and how to protect their portfolios from sudden price swings. In the end, measuring volatility isn't just about numbers. It's about understanding the risks and opportunities in the commodity markets. By using these tools and models, investors can better navigate the unpredictable world of commodity prices.